Thanks for joining us today here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker and Scott Kirshner. And myself, my name is Chris Vaughn. Whether you've been with us for a long time or you're a first-time listener or viewer, we appreciate you spending time with us. Here's how I reach out, 419-794-3030. That's the phone number, 419-794-3030. Always online, americasretirementheadquarters.com. On today's show, you can hear what a famous unretired football player offered advice to a movie star who's working once again. We've got the signals that can tell if you're on the right track to financial independence. And do you have the right financial components for your retirement red zone? We'll explain and go further into that. But first, let me check in with the guys. Scott is not with us today, but we do have Nolan Baker, Jeremy Baker, no relation, always have to say that, and Chaz Price. So, gentlemen, it's a triple threat. Glad to be with you guys. How are you doing today?
Doing great, yeah. It's good to be here. I had another great weekend, and last weekend was the summer showcase for hockey, so it was good to see my high school son get out there on the ice with some of the other high school teams, and it was a great weekend. But, yeah, great to be here.
Yeah, happy to be here, too. As I was saying earlier, Chris, just getting back from a trip to Miami, so feeling refreshed and rejuvenated, ready to go.
I'm happy to be here. Said I missed the hockey, and we talked a little bit of football. It's that time of year. I think baseball is the only sport that's the only big sport that's on. So looking forward to football and hockey season getting back underway.
It's a big departure from October when you have all the major sports playing at the same time. Kind of a lull, but if you're a baseball fan, it's a great time. But it's glad to be with you guys. Glad to share with you guys, and appreciate you taking time out of your schedule with us as well. So let's go ahead and jump into this week's show with. The chairman of the Federal Reserve says it's going to keep raising interest rates until it believes inflation is under control, even if that causes a recession. But at the same time, Jerome Powell admits, they were caught off guard.
One way to say it would be, I think we now understand better how little we understand about inflation.
That's not very reassuring.
No, but honestly, this was unpredicted. I was looking at our, at the time of our June meeting 1 year ago, of the 35 people who filed with this survey of professional forecasters, 34 of them had inflation below 4% for last year. And of course, it was way above 4%.
Way above 4%, I think, is putting it mildly. Guys, if the so-called experts can't predict what's going to happen, what defensive steps can those closer to our retirement take with their portfolio, which is something, that we actually can control?
Yeah, absolutely. I think there are some great defensive steps that people can take. One of the things that they can do, taking defensive steps and helping them avoid abandoning ship. Chaz, I know one of the things that you talk about in a lot of meetings that we have is people will oftentimes say, get out of the stock market. They'll go to cash, and then they'll wait till things get better. And, as you know, without having a defined investment strategy that can, help determine, when could be a good exit point or a good entry point, oftentimes what you're ultimately doing is selling when stocks have gone down, missing out on an opportunity when markets go back up. So you've got to get it right twice if you're going to go to cash and abandon ship. Mm-hmm. The thing is if you look at it, though, there are quite a few defensive steps. So even if the experts can't get it right, I think, what an investor wants to do is they want to be in a position to try to help control some of the volatility, maybe smooth out some of this declines that's happening. A couple ideas that I have are, one is protected equities. Protected equities is a strategy that allows you to buffer some of the downside. So if the market's down, in an example, like 20%, with a protected equity strategy, again, depending upon what strategy, that investor may only be down 5%. And in exchange for that, it offers a capped upside. So some of the caps that just came out this month are fairly attractive over the next year on what can happen. We then also incorporate that strategy in another approach called hedged equity. And so what hedged equity does is it takes a percentage of the money, and it buys some defensive strategies that would allow us or allow the investor to put losses at a predetermined level if and when the market went down. There are things like fixed index annuities is another good example. Fixed index annuity is an insurance product that offers a guarantee typically against loss of principal if the market goes down. In exchange for that, you have a capped upside or you have some type of participation. So final strategy that I throw out there, it's also a good idea to live off of the dividend income and yield in the portfolio. We have a strategy like our blue chip income, which is kind of a combination of dividend-paying stocks, some growth-oriented stocks, but also has some unique investments in there that generate more current income. So if you have quality companies that you believe in, then you don't have to worry about what the price is today or tomorrow if you're living off of that income from the portfolio. So, steps to take is really stress test your plan and look at your current plan. And in this, statement that the Fed talked about with continuing to raise interest rates, even if it causes inflation, where you want to stress test your plan right now is how it could impact with rising interest rates, guys. But what would you say?
Yeah, I think those are really good investment options to try to address some of the volatility in the markets. I am actually doing a seminar coming up on July 25th and the 28th about those, some of those exact same points about how do you thrive during a period of decline. That's actually the title of the presentation. And, one of the first slides that I have is actually Jerome Powell, making that statement that he pretty much blew it, and I think it's amazing how we as a people and as a country put so much faith in just a couple of individuals for our financial future. And so what we try to do and what I try to do in addition to some of those investment strategies is from a planning perspective, we try to address the things. I always tell clients, you have to be able to control the things that you can control. Try to focus on those things, and taking back control is the main point here. And so one of the things that I usually point out is try to understand what things cost. I think understanding the fees and some of the additional expenses of your investment, whether it be 1, 2, or 3%, whatever the cost is, that's money coming out of your investment portfolio. And so especially during a recession and a down period of time, every single dollar is going to count. So you want to definitely understand what things are costing you. The other point that I make is that, with the United States and demographically right now, I think there's about 12,000 people per day that are turning 65. It's estimated that by the time 2030 rolls around, over 70% of the population is going to be over 65. So, understanding how long-term care and health, expenses, medical expenses can impact your financial future, just being prepared for those sort of eventualities that you're going to have, it can be a big step towards preparing for retirement in a recessionary period. And then also understanding the sequence of return risk. The risk of, if you're not yet retired, what is the outcome, or what is the likelihood of you being able to accomplish your goals in a down market, and understanding what the effect of the market's ups and downs can be on your financial future. So we'll take a hard look at the sequence of returns and kind of just estimate what might happen in a Monte Carlo analysis, or a little bit more complex financial planning engagement that we can do for you here.
Yeah, sequence of return risk, it does become a big factor for those folks that are close to or in retirement time, what we call the retirement red zone. And you really want to figure out what steps can you take in the retirement red zone. And, as you point out, Chaz, somebody who takes, big declines in the market right at retirement time can have a major impact, where, somebody who's a lot younger, they're continuing to put money into their plan, over the course of time may not have that big of an issue. In fact, they're getting to buy money while prices are lower. So one of the mistakes that I have seen people make too in this type of environment is just saying, hey, I'm not going to put money into my 401k plan anymore because the market's down, and why throw good money after bad, sometimes they say. And that can be another dangerous scenario too, is even though the inflation's high, even though the market's a little bit scary, there's different steps that you can take depending upon what your appetite is for risk, without having to abandon ship, and to be able to accomplish those goals that you want to have.
I think a big thing too is when we take a look at doing a proper financial plan for folks, is we often talk about having a cash reserve, which is available for emergencies as well as opportunities. And the opportunities arise when the market is kind of in the state that it's at now. We look at, if you believe in a company, we talk about a company like Apple. If Apple's underpriced, and there's an opportunity to buy a good quality company at a discount. When you see people get news circulars in the mail, every time there's a sale at Target, everybody runs to Target. When there's a sale in the market, everybody seems to run away from the stock market. Stocks are down, 30, 40%, depending on what day you look. But most people tend to run away from those opportunities, and we encourage them to take advantage of those opportunities.
Yeah. Cash
So
is
Warren
king.
Buffett. Yep, absolutely. And, Warren Buffett famously says, be greedy when others are being fearful, be fearful when others are being greedy. It's not a thing, as you mentioned, Jeremy, when people, they take advantage of those sales, no one really goes to Target and goes, so this is going to go back to full price next week. I'll come back on Sunday. I'll buy it when the price goes back up. This is a great opportunity if you are properly situated to actually put more into the market, because here's the thing. The Fed is not being subtle about what they plan on doing. They plan on raising the interest rate more, even, like I said, even if it causes a recession. All signs are pointing to there being a market downturn in the future. And I think of Wile E. Coyote and the Roadrunner. When he chases the Roadrunner into the train tunnel and he sees the train coming, he just holds up an umbrella and he braces for impact.
Mm-hmm.
He could
Yeah.
just get off the track. That's a better way to do it. They're very clear about the fact that there is probably going to be market downturns. There's going to be interest rates rising. There will almost certainly be a recession coming in the future, whether it is this year, whether it's next year. But certainly over the course of your retirement, it's going to happen. So are you just going to stand on the tracks and brace for impact, or are you going to put steps in place right now to minimize that? Control what you can control. And that starts with putting together a plan with the team at America's Retirement Headquarters. Real easy. 419-794-3030 is the phone number. It's 419-794-3030 or online, americasretirementheadquarters.com. Click on the events tab over there at americasretirementheadquarters.com. You can see all kinds of events coming up, like the ones Chaz talked about, Retirement Today, Prosperity and Period of Decline, coming up on the 25th and the 28th of this month. You can get more information about that, including and seeing the other dates and events coming up by clicking on the events tab, americasretirementheadquarters.com. Now, guys, I ran across an article titled The 7 Deadly Sins of Investors in Volatile Markets. And it talked about investors who go into denial and claim that, well, this time it's going to be different. What's your message for them, for the person who came out of 2008 and said, I'm never going to let that happen to me again, but right now, doing just that. They're deciding to wait and see before they take any action at all.
Well, I think, the most dangerous words to say when it comes to investing is this time it's going to be different. After being in business for over 28 years, I think we've seen a majority of things happen. You could say when the U.S. debt had the crisis and the dollar got downgraded, that was the first time that's ever happened in the history, right? So, was it different that time? And look at, had you gone to the sidelines and sat in cash and missed out on what the market recoveries have been, you could say, this time it was different with 9/11. And, as a veteran-owned business, what a terrible thing that happened. But, again, if we look back after the initial shock happened to the markets and the economy, look at, again, where the markets are at today. And, there's been so many different times. Russia moved into troops into Crimea back in 2013. So, again, is this time with Ukraine something different? There's always been a reason that this time it's different. And at least in my experience, it's not different. It's a normal part of the economic cycle where, the markets go through good times and they go through bad times. Generally speaking, I think the market can handle good news and the market can handle bad news. What the market doesn't like uncertainty, and it certainly doesn't like shocks to the system when, you've got the Federal Reserve predicting inflation at 4 and it's actually more than double that. Those are shocks to the system, but they work themselves out over time. And that's back to what we were talking about in that previous segment, is where it takes and turns from crisis to opportunity, because there's not that many opportunities that the market gives you to be able to look for, some great quality things that are out there. And in part of the philosophy, as Jeremy was talking about, with our independent income system, and for those of you that are listening, if you're not familiar with our trademark system, the independent income system, just go on Google, type in the independent income system, and we'll share with you a quick video of where we see, opportunities and threats right now within the marketplace. But if you have these buckets in place, you have the ability to take advantage of some of these. I know recently I had met with somebody that had come into the office for the first time, and we were talking about where some of the opportunities were, but unfortunately, this investor was what I would call pot committed, right? So he had all of his money invested already in the market, so he didn't have any buying power. And that can create dangers inside of there too. So my answer to that is this time it's different is not going to be true. This time it's going to create opportunities like it has in the past.
Yeah, I would agree with that too. One of the just thinking COVID-19. Obviously when it first started peaking in March of 2020, that was a really scary time. I think just for everybody, but then for advisors in general, just because the market was dropping so quickly, 7% in 1 week and 30% in 30 days, were some of the terms being thrown around. And then 2021 ended up being one of the best years in history. So you're right. You really can't just say that because it feels different, maybe we should be making some changes. One of the things that I do talk to and advise clients, during an initial conversation is during the discovery phase, we'll ask a lot of questions, and one of them is, what have you done to prevent from, a 2008, 2009 crisis? And so I usually see their eyes open, and they're like, well, not really, not a whole lot. I'm just kind of, invested. And so that's, once the market's down, there's sometimes not a whole lot we can do for a period of time. It's just kind of wait it out a bit. But the real magic, I think, in financial planning and investing is done in advance by using the independent income system, bucketing amounts of money for periods of time that you're going to need it so that the dollars are invested appropriately for that time frame, and just knowing that and trusting that the plan and the time that you've taken to build everything out in your financial situation is prepared to weather storms like this so that you don't get scared away.
I think asset allocation is definitely a big key. I know when we talk about things like sequence of returns and overall return, the majority of it is derived from having proper asset allocation. A lot of times people focus on the small things like luck, timing. And right now, timing looks like, when the market's down, it seems like a good time to invest, but it also seemed like a great time to invest 3 months ago when the market went down. And it's like once, people talk about buying on the dip or, okay, I'm going to buy on the dip, but when's the dip or when's the bottom? And if you trust in your asset allocation, I think that's a lot of the battle. It's about probably 80% of the battle, having that proper asset allocation. And, all we really have is history to guide us. But I know coming into the business in late 99, I saw about 3 great months until March of 2000. And then, so I consider myself kind of a depression era advisor and always look to be a little bit more conservative. And I know for us, it's easy to have meetings when the market's just continually going up, which, we've seen that prior to COVID, probably 10 straight years of the market going up. And those are great meetings. But for us, to kind of earn our money as advisors, it's guiding clients through these type of times where it's kind of a hand-holding process. And, hey, trust the asset allocation. The market's going to come back. Don't panic. Don't make the wrong decisions on a whim or on an irrational basis.
Yeah. And I think this time, too, is different, or it seems different for people because of the bond market. It's one of the few times in history when the stock and the bond market are both down double digits. And so that may feel a little different. It has happened in the past, but not for a long time, since the early 80s, late 70s, I believe. And so there are some correlations to that period of time. But I think as a country we've saved, we're in a position a little bit better with savings. The Federal Reserve and the banking industry is a little bit more stronger, is a little bit better resolved. So that could contribute a little bit to it as well.
It's almost a situation where there's no place to hide. Like, in most situations, if there's an asset class that's depressed, or there's usually one or two, there's roughly 17 different asset classes between real estate, commodities, international, etc. There's usually something that's going up, but this is one of those rare periods of time where everything seems to be down. Bonds are losing money. It's like the only thing that looks safe or appears to be safe is cash, but like we talked about earlier, there are opportunities, and this is one of those cases as well.
Well, certainly the energy sector has been strong so far. And again, going back to like what you were talking about, using history as a guideline and what can investors learn from that. There are certain categories, whether it's rising interest rates or whether we're in a recession, that are investment categories, as you talk about, that might be better categories to own than other categories. A good example is that think of daily essential companies. So think of the companies that you need, whether we're in a recession or not, right? So every morning I'm getting up, jumping in the shower, and I'm brushing my teeth, right? every single day, regardless of the recession. I'm still going to the breakfast table, having my breakfast cereal. I still, drink a soft drink at lunch with, what I'm having for lunch. Those are companies that tend to be a little bit more defensive when you break down, some of those categories. The other thing I'd say is a tip and a pointer for those of you watching and listening to the show is when you look at asset allocation is a strategy ultimately designed to try to reduce risk, and what that means is that you're generally selling off your winners and buying your quote losers when markets change a little bit. So normally, like if the stock market is up and bonds are down, you're selling some stocks and purchasing bonds. And as Jeremy points out, this year is a little bit different because, in general, the stock and bond market are both down, but still don't ignore asset allocation. Look at asset allocation as something that you do on a consistent basis. And, how often would somebody do that? I'd say kind of maybe like a dentist's office. So every 6 months, you're looking to rebalance your portfolio and or rebalancing your portfolio during extreme times of volatility like what we're seeing right now too. Those could be some good things to do overall within your portfolio. And then, diving deeper into it, taking things into consideration like taxes. Most of the people listening to the show have some type of tax-deferred retirement account. Well, if you're deferring taxes to later, if all of this spending that we've had in our government, somebody's going to have to pay for that, and it could come in the form of higher taxes. If your investment account is lower, there could be some strategies to look to maybe do a Roth conversion as a good example and take advantage of where the taxes are. There's also tax strategies when you look at taxable accounts where if you have some losers that maybe you want to get rid of, you can take some of those capital losses and possibly use them for your tax purposes. In that scenario, or even in doing Roth conversions, no matter what the taxes are, you always want to consult with your CPA or tax professional to kind of find some things out. Something else, I guess, is, we're getting closer to wrapping up this first segment that I think is another good takeaway. One of the tools that we've utilized out in the marketplace to determine the asset allocation, to look for, where are possibly your winners and maybe, where could you cut losses on some of your losers, is a website called Morningstar. So Morningstar.com. What Morningstar does is Morningstar gives you a lot of facts and figures. So you can go over there or you can get together with like our firm and we can take your account holdings, and what we can do is we can put it into Morningstar, and then we can start to slice and dice and do an x-ray of the portfolio. Another good example of something that we have seen, if you go back to the crash of 2000, a lot of investors maybe felt they were diversified because they had 5, 6, 10 mutual funds.
Mm-hmm.
Well, back in the 2000s, those 10 mutual funds all still own the same technology. So when we had the dot-com bubble burst and the technology, kind of blow up, those were the areas that really got hit hard. And Morningstar allows us to look at style drift, portfolio overlap, get a good analysis of where those holdings are, and how to take a look at different places on where to position the portfolio. The final thing that I'd say is look at your road to recovery. If you're down a little bit, think about the investments that you own and don't drive looking in the rearview mirror. Instead, try to look forward and try to make a good educated decision about where might be a better opportunity for things as they recover. As an example, I think if you look at the growth potential between stocks and bonds, stocks historically have a better growth potential. And I think we're in one of those environments right now where, stocks and bonds, and again, depends upon somebody's risk tolerance, but if we're picking two and we say which one, since they both got beat up, have a better opportunity, I'd say there's some great opportunities out there within the stock market.
Mm-hmm. Yeah, I would tend to agree with that. Recently, we did an interview with another financial advisor, a CFA out. I believe he's the accounting and economics professor at the Citadel in South Carolina. He actually had an interesting statistic that when the 10-year Treasury note is above 3%, it tends to outperform the stock market. So to your point as well, it does make sense to own both, not to totally diverge from traditional asset allocation, but to still continue to own, both stocks and bonds according to your risk tolerance. So something to look into for sure.
Yeah.
It all comes back down to, not putting all your eggs in one basket. We've talked about this many times on the show. People want to feel like they're in control. And when it comes to the market and, what the inflation rate is, things like there's so many factors that are working against us where they don't have any control over. And so they try to make moves that, again, try to give them at least the illusion of it, whether it is selling stocks, whether that's the right thing to do or not, or, go all to cash or whatever. It's not to say that moves shouldn't be made, but they should be done tactically. And that's something that the team at America's Retirement Headquarters can help you with. I'm going to be a little contrarian here, where we keep talking about how people shouldn't go in with the mindset that this time it's going to be different. It is going to be different in the sense that, we're 14 years removed from 2008. We're all a little older, hopefully wiser, closer to retirement, or at least your time horizon is probably shorter. If you've taken a flight recently or ever, if there's turbulence at the beginning of the flight, it's probably not going to drift you so much from your arrival time. Whereas if you get closer and closer to your destination, any disruptions is really going to throw off that timing. So again, not something that we can control, but if you have the proper plan put in place, you can mitigate the effects of market downturns, of increased taxation, things like that. It all starts with a phone call to the team at America's Retirement Headquarters, 419-794-3030. Online, americasretirementheadquarters.com. And like I mentioned earlier, if you click on the events tab on the website, americasretirementheadquarters.com, you can register for one of the upcoming classes coming up at BGSU Levis Commons. Retirement Today, Prosperity in a Period of Decline. There's 2 coming up here at the end of the month. There's some in August if you can't make the July dates, but you can see what works best for you and go ahead and reserve your space there. americasretirementheadquarters.com. Thanks for joining us today here on America's Retirement Headquarters. A retired Hollywood star gets some big name help on how to unretire. We'll hear the audio from that coming up after the break.